One of my viewers, Emily, wrote me an email a few days ago asking about home equity investments. And I only made one video about this before, but I want to make another video about it right now because she had some questions on home equity investments, which is kind of similar to a HELOC or a home equity line of credit, but it's also not the same and kind of resembles more of a reverse mortgage. So I want to give you guys the scoop on what all this actually is and if you should get one or not. But the first thing that you should know is there is a very large and famous home equity investment company that's going through a big lawsuit right now. The company called HomeTap is facing a bunch of class action lawsuits because they're allegedly misrepresenting its products by describing them as purchase options contracts instead of mortgage loans in order to skirt federal and state borrower protections. Now, skirting borrower protections is not really a good thing, guys. And as soon as you hear that, the first thing that should come to mind is predatory. I remember some people making comments last time I made a video about this saying that they were happy with their home equity investment, but you might not want to do it after you hear what it is. According to the lawsuits, they're calling it a predatory and abusive mortgage loan product in order to peddle to financially struggling homeowners. And that's what all of these things are designed to do. Home equity loans, home equity lines of credit, reverse mortgages, all of these things target struggling homeowners, guys. So you have to be honest with yourself, like, why are you looking at doing this, right? Why are you looking at getting a reverse mortgage or a home equity investment or something like that? Chances are it's probably because you need the money for something that's more pressing, okay? And if that's the case, you need to tread with caution. Here's why. Because in a separate lawsuit, the company HomeTap was sued in Massachusetts back in February this year for violating state consumer protection and mortgage laws and putting vulnerable homeowners at unreasonably high risk of losing their homes. Think about that, unreasonably high risk of losing your home. Is that really a position you want to put yourself in? Especially if you have a tremendous amount of equity built up, maybe you have a paid off house. Like, you're taking a big risk by getting yourself into any of these loan products. This is arguably one of the most sneaky ones because there's no payments, right? There's no payments involved. Just like a reverse mortgage, like they're paying you. That sounds great until you dig into all of the dirty details on how they can turn around and take your house, and often do. And today I'm walking on Estrada Lane and El Camino Drive here in Corte Madera, California. Now, according to HomeTap CEO, he says that over the past 2 years, about 10,000 homeowners from different states came to us looking for a flexible solution, and they're not alone. There are still millions of people who have equity in their homes but haven't found a way to access it, and that meets them where they're at. And we're focused on reaching them one market at a time. Well, that's typical CEO talk, sounding like the hero. We're doing everything we can to help everybody who's in a struggling position. But at what cost, like I said. And here's how they get you, guys. The no monthly payment is the big allure to doing this, okay? Basically, they give you a big investment into your home. That's why it's called a home equity investment, which is a private contract that allows homeowners to secure a lump sum of cash in exchange for a percentage of their home's future value. So unlike other types of loans like home equity lines of credit and home equity loans, these home equity investments do not require monthly payments, which make them very appealing to financially distressed individuals with a low credit score who are in urgent need of cash, otherwise known as predatory lending. And under an HEI contract, known as the option purchase agreement, the homeowner agrees to let HomeTap purchase a chunk of their home equity in exchange for an immediate payout. And they all do the same thing. This is just one example of one company. And as part of the agreement, the company stipulates how long its stake in the property will last, usually anywhere between 10 to 30 years, and how much the homeowner will be required to pay back at the end of the agreement. And in most cases, homeowners have to settle the original lump sum plus a share of the home's appreciation over the term of the contract. which requires you to sell your property in most cases in order to fund the repayment. So if the home appreciates at a high rate, the payback amount can be double or triple the lump sum you originally got, although the contract typically does cap the annualized rate of return. But think about it like this: the more your house appreciates, the more of that equity that these companies are going to capture. But here's the problem, according to a real estate attorney. What a lot of homeowners tend to overlook is the settlement obligation at the end of the 10-year term. If the home has appreciated, the homeowner owes the home equity investment company its share of that appreciation plus the amount it invested. Most homeowners cannot write that check, so they must refinance or sell. So right away you might say, well, I'm 80 years old, Michael, so probably by the time that I'm gonna have to pay this back, then I might no longer be on this earth. And that might be a bet that you're willing to take, and that's the same sort of logic that people who get reverse mortgages use as well. But you also have to remember, guys, unforeseen circumstances. Nobody should know this better than you, than somebody who is a senior citizen who's been around the block a few times in life. Things happen in life that cannot easily be accounted for or predicted. And if you catch yourself in a situation where you outlive this loan, or you need to sell your house early for some reason, well, that repayment is still going to be due. Say you get one of these home equity investments and 5 years later need to move into a nursing home. You got to sell the house. Well, now they're going to take a big chunk of your equity plus the original amount of money that they gave you, which is leaving you a lot less cash when you sell your house. They talked to one woman who actually got one of these home equity investments right here in California, and she got that loan in 2020, and her house was appraised for $305,000, and the firm bought a 13% stake in her equity, giving her a lump sum of $44,000 to pay her bills while she was unemployed. But the lawsuit claims she received only a little over $40,000 due to various fees and deductions. So right out of the gate, they kind of screwed this person over, which is not really a good look. And according to the lawsuit, the contract was complex and confusing and was underwritten without the regard for her income, assets, creditworthiness, or future ability to repay the lump sum. Because they don't care, they're using the house as collateral. That's the only thing they're interested in. Even if you're dead broke and your credit score is horrible, they don't care if you can repay the loan because your house can. That's the whole thing, guys. That's what you need to understand about all of these different types of loans against your house. And then, of course, if you cannot pay your obligation, then you could lose the house. And these companies specifically target people who cannot qualify or afford a traditional mortgage or traditional refinance. A lot of homeowners are at risk of being forced out of their homes by a home equity investment loan when their 10-year contracts mature. It sounds like these 10-year contracts are a lot more common than a longer term one. Probably because they want to get in and get you that loan and get their return on investment back sooner than later. Nobody wants to wait 30 years. Another lawsuit out of New Jersey claims that HomeTap gave this couple a $98,000 lump sum for their house on a 13% stake of the equity, which was appraised at $802,000. And just like the previous person, they said their 10-year option contract was underwritten by HomeTap without regard for their income, assets, or future ability to settle. And so if HomeTap were to exercise their option contract right now, so that's the other key to this of why this is a big deal. It's a 10-year contract, but they can call in the loan. You can sort of think of it like that, which means that they can essentially make it due early depending on how much your home's value is going down or what's happening in the market. And that can really catch people off guard, right? And so if this couple in New Jersey would get their loan called in right now, they would be on the hook for $177,000, guys. They got only $80,000 initially. And that's way beyond what they can afford, but their house can afford it. So if you notice, the two main issues here with this are, number one, that these companies can demand and or call in that loan at any time they wish according to the contract. That's a huge red flag, number one. The second red flag is you can be on the hook paying double, triple, of what you initially got just to get some temporary cash. I mean, think about what kind of an interest rate that is. You know, if you have to pay back triple, how much of an interest rate is that? 300% interest? It's not worth it. But people all the time are asking about these type of loan products. And I'm not saying that no one's ever had a good experience and that it can't work. That's not what I'm saying. But I am saying that you need to be careful on who you do business with. Check the reviews, make sure the reviews are actually real people, not paid bots on the internet. Maybe even get a recommendation from somebody else you know who might have done one of these and has had that product for a while and hasn't had any complaints. Because a company like HomeTap, their agreement stipulates that if any of their clients cannot make the required payment, then the company can foreclose on their property or force a sale to collect the amount owed. Who wants to find themselves in this position, guys? Same thing with reverse mortgages. They have all sorts of maintenance requirements and upkeep requirements, even living requirements requiring you to live in the property and you can't move out and all this and that, all this little fine print. And if you can't comply with something that is in this contract that you might not even be aware of, guess what? You're losing your house, you're losing a chunk of your equity, all because you wanted to borrow against the house. And I'm not sitting here telling you that no one can do this and it's always going to be a bad idea. But I think that just like the reverse mortgage stance, I stand pretty firm on the side that if you actually need to do this out of necessity, then you probably shouldn't, which is unfortunate because that's most of the people who are looking at using one of these products. And the class action lawsuits that are going on right now are all about whether or not this is actually supposed to be considered a loan. Because according to the Truth in Lending Act, it requires that consumers are offered and receive residential mortgage loans on terms that reasonably reflect their ability to repay the loans and that are understandable and not unfair, deceptive, or abusive, which is basically the opposite of what we just talked about here. And these lawsuits, as long as they just, give out little settlements here and there to the people who win these lawsuits, it's like a nothing burger for these companies, guys. It's just the cost of doing business, essentially. How much home equity can we steal from different homeowners, and how many lawsuits can that fund and still make us a profit is the spreadsheet calculation that companies like this have to do. Of course, HomeTap denies these allegations of it being predatory, and they say that they're fully transparent on what their product is and what it does. And some of that could actually be true because a lot of people out of desperation overlook what the contract actually says in desperation just to get their hands on the money, and the consequences become an afterthought. So what are the pros and cons of this type of thing, guys? Well, obviously the biggest pro is no monthly payments. That's what pretty much ropes everyone in. You only have to pay when you sell or refinance or at the end of the agreement, which can be cut short without your permission, right? Another big draw in is that you can qualify with little to no income and bad credit, which is something you can't qualify for when you do a traditional refinance or a HELOC, for example. Also, if you have a low mortgage rate, you can preserve that low mortgage rate because you're not taking on a second loan, at least not one that requires regular payments. Also, you can use the money for whatever you want, which is pretty much the case with all of these different types of loans against your property. And here's the funny one. There's no interest charges, right? But how much interest are you paying if you end up paying triple back what they gave you? I would say quite a lot. The cons are pretty obvious. You give up a lot of your future appreciation. You don't have a lot of control over when that loan can be called in. Even though you might have a 10 or 20-year agreement in the contract, these companies can call it in early, and which can put you in a pretty bad spot financially. And this can be way more expensive than a traditional loan like a HELOC. Like, as much as I don't like HELOCs, guys, I think that's a safer bet because here's the thing. When people do HELOCs, first of all, you don't have to borrow it right away. You have time to think about it and all of that. And even once you start borrowing it, you're not making the full repayment amount right away. But also, people tend to borrow less. These are some pretty big numbers we went over here, like $44,000, $80,000 being borrowed against their house. Typically, when people do HELOCs, it's less than that. Maybe like 20, 30,000. It's still money. You can still lose your home to foreclosure to one of these loans, but you might have a lower risk if you do a HELOC versus one of these home equity investments, and since you have to qualify for a loan like that, that means you are going to have income to actually repay one of these loans and not just be on the hook through the value of your property, which is pretty risky. And another big con against doing this is that these companies specifically target people probably like yourself who are looking for this extra money for one reason or another. You know, there's all these complex algorithms and AI and things that companies use now to specifically zero in and target people who could be vulnerable. And that's exactly what they do, guys. You think it's an accident? You got one of their mailers talking about doing a home equity investment and how it's so much better than these other type of loans? Think about it.